Hi, my name is Jordan Wilson. Today we're going to continue with our look at investor profiles, this time with a focus on financial objectives and investor constraints. So if we look at financial objectives, the first one on the list is emergency funds. That's liquidity to deal with any emergencies that pop up. Now, different people have different recommendations as to the amount to keep aside. Some will say 2 to 3 months. Some will say a percentage of your assets, maybe 5 or 3%. But I have here sort of 3 to 6 months of basic living costs to be held in liquid funds. Now that's going to change over time as your personal situation changes. For example, if you're a college student, then you don't have a large asset base. You probably need to keep 3 to 6 months cash on hand. When you're 35, 40, 45, and you have that strong base, then you can get liquidity fairly quickly from less liquid assets than cash. For example, maybe a mutual fund of bonds or even large cap blue chip stocks. Unless the market is down and you suffer a loss of some sort when you sell, at least you'll be able to sell quickly because they're highly liquid as far as those asset classes go. But since you don't have that when you're a college student, then yeah, you'll have to maintain cash or cash equivalents. And by cash equivalent, I'm talking, say, a money market fund. Those sort of things where you get a slightly higher yield than putting your money in the mattress in your house, but you're not making much. The next 2 points I'd like to make are on priority of objective and the time horizon of the objective. I think priority, you want to break them down into high, medium, and low. So a high priority might be your retirement, maybe buying a new house. A medium priority, maybe that's a lake cottage or a winter home in Arizona. A low priority, maybe that's a midlife crisis where you invest some fun money, and at age 50, if it's done well, you end up with a Porsche. If it didn't do well, you end up with a moped or a pedal bike. But it's not going to make or break you, the lower priorities. Time horizon, subjective as to the year breakouts that I use, but near term is short term. For some people that might be 1 year, others 5 years. I kind of say 3 years is sort of a short term. Midterm, we're talking more sort of that 5 to 15 year time range. And long term, let's say 40 years, 30 years. Basically, you're looking at long-term retirement in these cases. I like using a matrix type approach when I build financial objectives for clients. On one axis, you have the time, the other, you have your priority, and you create 6 different boxes. And those boxes are going to help guide you as to what investment patterns you take to hit each of the priorities, and especially the high priority ones. So what do I mean by that? Near term high priority. That would be your box on the top left corner. Maybe that's a down payment on a new home that you want to buy in 12 months. So you need increased certainty of return, safety of capital. You'll sacrifice risk and return to ensure that you have highly liquid assets that are available to make that down payment. You can't really afford, if you need $100,000 for your down payment, to only have $80,000. So you'd rather not worry about the return in exchange to make sure you have the money on hand when you need it. The opposite of that might be a long-term high priority, such as retirement. So in 45 years, you want to retire, live off your wealth. Yes, you want safety of capital in some context. You're not going to invest in frivolous, high-risk ventures. But you can also assume more prudent investment risk in order to attain higher expected returns over time. Because it's 45 years out, you don't need that liquidity. So you can invest in a wider range of products. You'll also use tools such as diversification so that you can manage your portfolio risk effectively. On the other end, you've got the lower priority. Those can be near, mid, or long-term in nature. They're nice to have, nice to attain, but they're not deal breakers in life. If I invest some fun money for a Porsche for my midlife crisis, if I get it, great. If I don't get it, it's not really going to impact my life. Versus if I don't save enough for retirement, or I don't have that money on hand in 12 months for the down payment on the home. So with lower priorities, you still want to match your risk to the time frame. But often what you'll find is that investors take a more speculative approach on their lower priorities because the priority is not as important. They're willing to take on a little bit more risk in the hopes of chasing higher returns. And the final objective that I want to list here is entrepreneurial. That can also cover any time frame. And I think if you're running a small business, it's probably a longer time frame. If you're just investing in private ventures, maybe that's a shorter time frame. Often you find with entrepreneurs that they have all their eggs in one basket. So you start an electrical firm. You start a chiropractor's office. You're taking all your assets, your money, your time, your energy, and you're investing everything into that business. Often what you find with entrepreneurial ventures is that they're higher risk, higher reward. So that's also an objective to consider. Maybe not pure finance as far as investing in stocks and bonds, but it is an objective for a lot of people. Personal constraints. Liquidity is a big personal constraint. We talked about emergency funds as a financial objective. They're also a constraint. You need to set aside money for emergencies. That's money that cannot be invested elsewhere. You also want liquidity for your shorter term planned acquisitions. So my car still runs perfectly well. It's not an emergency. It hasn't broken down and died. But I'd like to buy a new model in 6 months' time. That's a short-term planned acquisition. And you do need liquid funds. On a smaller level, it's like I need to buy a house in 12 months, so I need a down payment. The other one I list here is investment opportunities, which a lot of people don't factor in. And I could be fully invested with my portfolio in stocks, bonds, whatnot. And someone comes along and says, here is an excellent investment opportunity for you. Great. But if I can't access liquid assets to invest, then I might have to sell something else, maybe at a loss. Maybe there's opportunity costs involved there, like tax or transaction costs. Things that say, okay, maybe I don't want to sell. But if you have a little bit of liquidity on hand, that might give you access to new investment opportunities. Free cash flow is another constraint. We discussed cash flow and balance sheets in the financial situation portion of this look at investor profiles. Free cash flow can be a positive in the sense that you have lots of cash, so you can invest easily. But for most people, it's usually a negative. It's hard to find excess cash to invest. Now, the problem with free cash flow is that wealth accumulation is a function of your funding, your contributions, your investments. It's also a function of investment risk and time horizon. And the three are interrelated. So if you lack cash to invest, you're going to need a longer time horizon and or take on increased investment risk. Time horizon, also a personal constraint, and also one that can be a positive if you're young, but again, for most people, it's a negative. I think your typical investor starts investing a little bit later than they should. That's just the way life goes. You cannot go back in time. So if you start investing when you're 25 on a monthly basis until you're 35, you can often see these charts that show you stop investing after 35 and just let the money compound. You're better off at age 65 than if you waited until age 35 and then invested every month until 65. So you've contributed a lot more of your own money over a lot longer period just to catch up with the person that started younger and then stopped. And we'll look at that and more when we look at compound returns. So if we look at a simple example of the relationship between time, funding, and risk, my goal is to attain $1 million in 40 years. I'm going to invest $400 per month, earning 7.5%, and that will get me to just slightly over $1 million in 40 years' time. But what if I had to wait? If I wait 10 years, that same $400 per month at 7.5% only gets me to $500,000. That's half of what I wanted just by waiting 10 years. I'm still investing for 3/4, 30 out of 40 years, but I only come up half as much as I wanted. If I wait 20 years, I end up with just over 200,000. And if I only start investing in the last 10 years, I end up with 68,000. So if I want to reach that million, I've really only got two options. I can increase the risk of my portfolio. In this scenario, if we still do $400 a month and I wait 10 years, I've got to earn 11.5%. Now that's significantly higher than 7.5. Maybe it's attainable. It doesn't sound like that high. But if we look at 20 or 30 years to wait, I need to earn 21% per annum over 20 years to reach the million. And for 30 years, I've got to earn 63%. That's a lot of investment risk to take on. And I think the 63%, there's not a lot of portfolios you could create that could generate that return. So you have a bit of a cap, I think, on the amount of risk that you can prudently take. The other variable is increasing your funding. If I wait 10 years and I'm still going to get the 7.5%, instead of $400 a month, I've got to put in $800, double the amount just to break even with the person that started earlier. If I wait 20 years, now I have to invest $2,000 a month. And if I wait 30 years, 6,000. Now I will say, if you have the money to set aside $6,000 a month, which is $72,000 a year, even for a 10-year period, you probably aren't worrying about $1 million at your retirement. And that again is a constraint, is that the reality is how many people that waited that long to start investing realistically have $6,000 lying around every month that they can invest for 10 years. So an interrelationship between time horizon, funding, and risk of the portfolio, and it's all trade-offs. Going back to the personal constraints, tax is a big personal constraint. That might be your personal tax bracket. How much tax are you paying on a marginal or an effective basis? Domestic tax laws play a part. For example, in Canada, tax issues relating to investors might be how dividend income versus interest income versus capital gains may all be taxed at different rates. How dividends from Canadian eligible corporations are taxed at a lower rate due to the dividend tax credit than a non-eligible dividend or a foreign dividend. So these factor in. You might see tax impacting different investment vehicles. For example, when the creation of the registered retirement savings plans or the TFSAs came in, those adjusted people's behavior. And if they start capping some of these investment vehicles, that's a constraint. If they change the way that they're taxed, that's a potential constraint. If they increase the cutoff rates for things like Canada Pension, because they're called clawbacks. So you make more money externally, so they're going to cap what you can receive from Canada Pension, for example. That's a constraint. Foreign tax laws. If I own property in the United States or elsewhere, I have foreign tax issues that I have to deal with. Even if I own mutual funds or common shares from a different country, there might be withholding taxes involved. Some countries I can reclaim that through reciprocal tax agreements. Others I might lose money on it. So again, tax, big issue. Legal and regulatory environment. Often that relates to institutional investors more so, but even for individuals you have to be careful. Employment related, for example. When I was at Pricewaterhouse in the old days, you'd always get these emails coming around that you couldn't trade in certain companies. And that's because different arms of Pricewaterhouse were doing corporate work for them. So there were trading restrictions on the entire employment units. When I was at UBS, I had restrictions, as did all staff, on maintaining external bank or brokerage accounts. All my financial accounts had to be with UBS so that they could ensure that I wasn't engaged in insider trading or front loading if I was dealing with clients, these sort of things. So that's an issue. Insider trading can be an issue, and it can be always sort of innocuous as well. It can be by accident, but you still may be investigated by the SEC or wherever you're living. Trade sanctions, that could also be an issue. For example, in Iran, there's lots of countries where the individuals and businesses are not allowed to trade with Iranian companies or invest in the country. You need to know that. North Korea would be another. In the old days, South Africa. So again, there's legal regulatory restrictions that may impact your client or you as an investor, and you need to understand them. Unique factors also play a part. ESG, environmental, social, governance. So some clients, some investors prefer to deal with only good corporate citizens. They don't want to deal with tobacco companies, oil pipeline companies, alcohol companies. And so because of that, you have to tailor the investment patterns to account for that. Sharia compliant products. That's very big actually in Europe, and it's starting to creep into North America. But many people of the Muslim faith will not invest in interest-bearing products due to their faith. So many companies have come up with Sharia compliant products to address that market need. Often, asset size plays an issue. There's hedge funds, there's private funds, access to IPOs may require a certain level of assets before you're allowed to be involved. Maybe if I want to get into a specific mutual fund or a hedge fund, I need 100,000 or I need $1 million. Maybe if I want access to an initial public offering on a new company, I need to have a certain amount of assets to get preferential access to these shares when they're issued. So again, those are some unique constraints involved. The final point that I'd like to make in this session is how time impacts both your constraints but also your objectives, and you need to be aware of both. So what I mean there is we talked about long-term high priority, your retirement in 40 years. But in 25 years, you still want to retire, but that becomes more of a medium-term priority. And then 40 years out, it's a near-term priority. And you need to adjust your boxes accordingly. And that's going to impact the type of investments. We talked earlier about high priority, low term, safety of capital, sacrifice return to take on lower risk, liquidity issues. Much different than the long-term high priority, which could be in less liquid, higher return vehicles. So as your time horizon changes, you need to shift your objectives into different boxes. The second point is milestones. And what you need to do here is track your progress on your objectives. And that's part of your annual return review process as well, is, okay, I expect to earn 10% on my retirement portion of the portfolio. But I notice that in the first year or the first 3 years, it's only returning 7%. So you may need to, as time passes, either increase your contributions, adjust your asset allocation to take on riskier, higher return assets. Because as the time passes, we just saw this, those are really the only two things that you can do. But what you don't want to do is you don't want to wait on that 40-year time period until 20 or 30 years out to realize, oh, I haven't been funding it as it's needed because the return wasn't there. So again, for all of your objectives and especially the longer term ones, you need to have intermediate and probably even more frequent milestones to assess the ongoing performance versus the actual results. And as we saw in the previous slides, if you correct course soon enough, it may not be that onerous. But if you wake up without having reviewed your retirement portfolio for 20 or 30 years, there's a good chance that on a practical basis, you won't be able to boost your funding high enough, or you won't be able to take on enough prudent risk to compensate. So even if you're looking out 40 years on your retirement, in your annual reviews or your first 3 to 5 years, set a milestone. Okay, I expect to earn 10%, and it's 7 years hence, my portfolio should have doubled. And as an aside, that's just the rule of 72. If you Google that, that's a nice little rule of thumb on investing. So again, track your progress, create milestones, move your boxes as time passes. I think that's important. I think that gives you a decent overview of financial objectives, personal constraints, that when you build your own investor profile, these will give you some ideas on what to include or at least consider. I think the biggest takeaway is creating the matrix of the boxes so that you make sure that you identify, especially your high priority, but if they're short, medium, or long term in time horizon. Because when you start building your target asset allocation and your investments themselves, you need to make sure that you target each of those investment objectives. If we have a cookie cutter approach where we're going to focus on a 45-year time horizon for retirement, maybe we miss out on having liquidity ready in a year's time for a house, or starting a family in 3 years' time. So you need to know what your objectives are and where they fit on the time spectrum, and then tailor your investment stream accordingly so that you hit all them. That's all for today. Thank you very much. And we'll move on to a little bit more on investment profiles next time. Have yourself a good day.